Cathie Wood, back-to-back days we're reacting to a Cathie Wood video. Yesterday we did a video of her on Bloomberg, and then this one's out 11 hours ago. Looking forward to watching this one, see what she has to say in regards to this video. The Fed wants to make sure its job is done. Hear what she has to say about that, as well as any other subjects. Second video we're going to react to in this one here tonight is time is the enemy of the market right now. This should be an interesting kind of debate or talk here, and so I figured we'd react to that one as well. It's a buy one, get one free. Thank you, everybody, that subscribe to the channel. We're getting close to 24,000 subscribers now on this channel, so thank you, every single person that subscribed to the channel. I appreciate each and every one of you, as always. Also, everybody that supports us on Patreon, thank you for supporting on Patreon as well. If you are not familiar with the Patreon, essentially you get to see me actually build out a portfolio. You get to see the stocks I'm buying and selling inside there every single week. And so if that is something that sounds cool to you, definitely check out the description area. Also be the pinned comment to join us on the Patreon. It's like $2 or $2.50 a week. It's a no-brainer to be part of that, and I get to see exactly what moves I'm making, how I'm building out the portfolio step by step. It's pretty darn awesome. Alrighty, guys, let's get into this.
And CIO, what a treat for us. It's good to have you back, Cathie.
Oh, I'm happy to be here, Carl.
Most dislocated ever. Ever's a long time.
Ever's a long time, but from last year, the bond market at one point had never performed as you had to go back to the 1700s. So long duration assets were creamed, including our innovation strategies. And it was all because of fears of inflation and higher interest rates. We do think inflation's coming down now. It always seems like it could come down faster, but we do believe it's on its way down. You listen to corporations out there, even those who have had pricing power, the staples, P&G, they get their pricing, but they lose the volume, 6% declines in volume for a staple company. So
one of my companies is stealing market share from them.
We do think the consumer is
actually two of my companies are stealing market share from them, thinking about it now.
Against inflation, and the Fed certainly is doing its part, and money supply growth is down. Our estimate is roughly 3% on a year-over-year basis. We haven't seen a decline in money supply since the Great Depression in the 1920s.
So you see these most recent hawkish hand-wringing as the death gurgle of inflation, one last attempt to try to make its voice known?
I think the Fed really wants to make sure that it has done its job, and job owning is part of it. But I do believe the equity market, certainly the way we've started the year, are beginning to see to the other side. And sure, maybe they go up another 25 basis points, maybe 50, I don't know. But I think we're just about there. And the market is a discounting mechanism after all. So if it can see to the other side, then we should be okay.
It was looking like that in January, but then January data all came in really strong, including inflation, with the PCE going in the wrong direction. So the market has sort of changed its mind from your view, and now thinks we're going to have a series of more interest rate hikes, and they're going to have to stay higher for longer, and the economy is going to get hurt worse than expected.
Yeah, this is going to date me. This reminds me of early in my career. In the early 80s, it was the same thing. But those who bet on lower inflation and interest rates long term were the winners. And it's always the data. The data are very volatile, especially when you have the warmest winter in history here in the Northeast. So I think that's distorted the numbers quite significantly. And the interesting thing about seasonal factors, if that is the distortion, they all have to work out to one over the full year. So if they bumped the numbers disproportionately in January, it'll come out of other months.
I don't know. February's a little warm, too. Yeah. Some people look at your ARK Innovation Fund, Cathie, as a barometer for what the Fed is doing, right? And they say it's back on the rise. Speculative behavior is back. Unprofitable tech companies are getting bid again. The Fed has more work to do.
It's very interesting that people do link the two together. I think that the muscle memory has more to do with the tech and telecom bubble and bust, and people fearing that we may be in the same situation. We are not. In fact, the seeds for everything that's happening today, all of the innovation that's happening today, they were planted in the 20 years that ended in the tech and telecom bubble. But the technologies back then were not ready. the costs were way too high. We didn't get the big breakthroughs in artificial intelligence until deep learning 2012, transformer technology 2017, and now finally we have a chat GPT. People are beginning to understand that the ground is shifting underneath us when it comes to innovation. Unlike in the late 90s, investors rushed into the late 90s, weren't ready for them. Now they're running away. They really are running for the hills. And what are the hills? They're benchmarks. That's where they think safety is. But if we're right, the benchmarks, which represent the traditional world order, are going to be disintermediated, disrupted by the most massive innovation period in history.
All right, hold your horses for just a moment. Hold your horses, okay? So I got to push back on this. Okay, first off, I kind of agree with her in the whole, people are running back to their benchmarks 100%. Yeah, 100%. But as somebody, I own mostly profitable stocks. Like the majority of the stocks I own, which I probably own 25 different stocks, the majority are profitable. But I own several stocks that are unprofitable. And here's the issue. When you're talking about unprofitable companies, it's very difficult to value those. And some people assign a value of 0 to an unprofitable stock, right? Because that's the way some people look at it. Like, if it's unprofitable, I don't even consider it 0 for me, okay? And so when she looks at it from that perspective, like her perspective that is, I think she needs to look at it from a little further out perspective and just understand when you're valuing a company that loses money on the bottom line on a quarterly basis, on a yearly basis, it's very difficult to value those companies. It's very easy to value a Coca-Cola and Pepsi and say if it's undervalued or overvalued, right? Very low growth rates, net income that's very stable. Like you can run those numbers, right? You can run the projections. You can look at historical average for the past 10, 20, 30 years. And you say this stock's overvalued. This stock's undervalued. With unprofitable companies, it's very, very difficult. Now, that creates tremendous buying opportunities sometimes for these companies that are unprofitable and then switch over to the profitable side. And you can see an insane move up in their stock price. Very similar to obviously what we've seen with two of my companies, right? Elf Cosmetics would be a perfect example of that, where they were unprofitable when I first bought into that stock. They were actually losing money, right? And that's my biggest gainer over the past several years. It's like a 900% plus gain, right? Tesla, my second biggest gainer, which is at, 800% gain or whatever as of right now, right? It was at a lot more at the peak of Tesla. There was another perfect example of a company that went from losing a ton of money to then making a ton of money, right? And so I think that's very important to factor in as well. The problem is not all unprofitable stocks ever get to profitability levels. Some go bankrupt. Some have to, just dilute their shareholders to death essentially, right? And others sometimes are bought out for pennies on the dollar by a bigger conglomerate company that looks at that as a attractive buying opportunity, okay? And so those are factors I think Cathie Wood has to consider. I think sometimes she just gets so stuck in her ways and only looking at it one way. And I understand she has to defend her side, but I just feel like you can be a little more even and understand these different angles, especially for folks that are more sophisticated in the market. They get it, they understand it. But if you're only looking at it from one way, sometimes people almost cast you away a little bit, and I worry that happens to her sometimes, okay? Because she only looks at it from one angle and not these other perspectives, in my personal opinion. So, yeah, that's the Cathie Wood clip. Next one up here. This one's from a few hours ago here, 10 hours ago. Time is enemy of the market right now. What are they talking about here?
Stock Exchange. There's Joe Terranovich, Sarat Satir in the house, Steve Weiss, Amy Raskin with us as well today. Let's check the markets. We did have a pretty...
That's my jam right there when they play that music on CNBC. You got to hit that, have the
nice
bass
bounce
going.
Off the open, though. You can see here a lot of that has now evaporated. Dow's good for just less than 70 points. S&P 39.87, and there is the NASDAQ, which is still positive as well. But, Joe, I go to you first, and I referenced this series of trades that the Wall Street Journal noted from the CBOE and their data. More call options betting on the VIX will rise have changed hands on an average day in February than at any time since March of 2000. What does that tell you about what may lie ahead for volatility in this market?
Tells me where sentiment is. And sentiment right now is back to being uniquely bearish, the way it was in the fourth quarter. We're seeing that type of bearishness play out once again. I wouldn't get too excited over this little bounce that we're having today. S&P has to get above 40-50 to reverse a lot of the negative momentum from last week. So a lot of the conversations that I've had in the last several days and really it's in the financial advisor community, is if they're sitting on cash right now, right, what's the incentive for them to be compensated to take the risk where the runway right now seems a lot longer with monetary policy? There's so many unresolved answers, whether or not the earnings contraction that we saw in the most recent reporting season is going to evolve into an actual earnings recession. So why step in? And there's competition right now for equities in the form of a higher yield. It's just a very difficult environment, and that is extrapolating, leading to this consolidation type range.
Oh, how things, Sarat, change in the course of 2 to 2.5 weeks. I feel like that strong employment report was kind of a gut punch for the bulls because it only reinforced what the Fed was going to do. You had some tough Fed speak since then, but the bulls had the upper hand, at least to start the year. Sentiment seemed to have changed. Momentum was back in the market. And then here we are questioning everything again.
Yeah, Scott,
hold your horses. Wait just a moment, okay? Bulls still have the upper hand. Like, bulls still have the upper hand in this situation, right? They have a very slight upper hand versus the bears right now. But let's not confuse this. We've had 1 month of kind of a hot inflationary reads, right? And so you can't just run to the perspective of like thinking that's just going to continue on for next month and the month after, like 1 month, okay? And so bulls had several months where the data was going in their direction, right? Now, everybody kind of freaks out in the short term because it's 1 month and they assume like every month is going to be like that for now at this point in time. The bears get full momentum again if we have another hot month next month, and there's obviously worries about the next month being hot as well. That's when bears take full position of the market, because then at that point in time, then everybody's going to go to the assumption that the Fed's going to raise at 50 or 75 basis points several times throughout the year, whereas almost everybody going into this year thought maybe 2 25 basis point moves, and that was it. But I can tell you, if we get more hot inflation numbers next month plus another month, then everybody runs to 50 or 75 basis points and starts freaking out again. So that's when, at that moment, bears would be back in control of this market. I don't feel bears are in control right now, but they can get there. Okay, bulls are slightly in the lead in this position, not by much, but they do have a slight lead.
So you're right. So I mean, when we started the year, leading indicators were coming down. Inflation numbers were kind of subdued. We were talking disinflationary. Then all of a sudden,
right, Jay Powell said it like 1,000 times.
Right,
in the
disinflationary, right? And then all of a sudden, you get that strong employment number. The PCE comes out stronger. All of a sudden, the bond market now in the short end is going higher and higher. The back end is still lower, so that's kind of conflicting. But when you get, to your point, Joe, a 6-month Treasury, I was having a talk with a client today at 5%, and do you take that opportunity with excess cash or side on cash and say, we would always talk about if you have cash on the side, what are you going to do with it, right? Right now, you have 5% for 6 months. So what are you going to, what's the downside of that?
There are even some daily money markets that are.
Let me explain something that I think is very important, okay? And I haven't heard anybody talk about this yet. Very important. Think about all the people that have money in treasuries right now, right? And are playing that whole game and are collecting their 5%, as he says right there, right? First off, that's beautiful. People are making money basically risk-free, okay? Making a ton of money. Eventually, much of that money will make its way back to the stock market. It's not there right now, and that's perfectly fine. It gives people like myself and other longs great opportunities to buy a lot of stocks at heavy discounts, right? And hopefully we get some more of that in 2023. But that money will return to the stock market because, if you think treasuries forever and ever are going to get these great returns, I don't think that's very realistic. They're getting those returns for right now, and everybody have fun and make that money over there. But believe me, as soon as you get any real weakness in the economy or something like that happens, believe me, they'll start cutting rates, and then things will shift as far as all that goes. And the way treasuries are being priced, the way bonds are being priced, like everything will start to change pretty dramatically. So I just look at that as like, cool, everybody make more money over there, basically risk-free, and get ready to come back with that money maybe in a year from now, 6 months from now, 18 months from now. I don't know when that money starts falling back over. But at some point in time, it's coming back over to this baby in this game, okay? And so I look at that as a long-term investor, as a net positive in a huge way. For the short term, I'd rather have less money in the market right now and less buying pressure because I'm a buyer, obviously, right?
Out there competing with the yield you're getting from treasuries at plus 4.5%, which to your points makes the bonds versus stocks argument the most compelling that it's been in an awfully long time.
Look, the market is always, and that's why there's volatility, and you began the show highlighting the volatility, the increase in actions for options during the month of February. There's always volatility in the market. There's always the appearance of having uncertainty. But this seems like the uncertainty that's been permeating throughout 2022 is now extending into 2023. It's staying around a little bit longer than investors are comfortable with. And I think that feels a little bit different than the way we felt over the last 13 years since the great financial crisis. And you don't have the liquidity there anymore, Scott. The liquidity is not there to kind of sop up the pessimism. So, listen, I told you the other days, I'd be surprised if we go back to the lows from October. I think we're safe there. But I also don't think we're racing back towards 4,800. I think we've got to mark time. It's the enemy of the market right now.
Yeah. Guilty until proven innocent, I suppose, Amy, is the way that these rallies are going to be judged. Mike Wilson, triples, quadruples down today. Given our view that the earnings recession is far from over, we think...
By the way, the main point that gentleman just made there is we're basically range bound, meaning, we can kind of bounce around, let's say anywhere between 3,800 and maybe 4,200 for the S&P 500, but you're not really going to make a big move down or up as of right now because you just don't have enough on the bullish side or the bearish side to really push the market up in a huge way or down in a huge way right now. That can obviously change over the next 3, 6, 9 months, depending upon how earnings come in, how the inflation data comes in, what the Fed does, all those sorts of things. But as of right now, you're just in a very range bound, like I said, bulls have a very slight advantage right now, but it's not big enough to have this market go scream in bull mode right now.
It's a high risk month for the next leg lower in stocks. Ultimately, we think this rally is a bull trap. Look, I think you've been fairly negative, but I feel like over the last couple of times you've been on, you've tried to see a little more positivity in things. But here we go. Sentiment feels like it's all of a sudden reversed back to being overly negative.
Well, I think what we're seeing now is that the economy is running hotter than people expected. I mean, much hotter than people expected. And inflation's running hotter than people expected. So as long as those two are going together, I'm not overly worried about it. I think the bear case scenario is that inflation stays very high.
Let me explain something super important for everybody watching this video right now, because I don't want this to screw you up long term, okay? She's talking about the economy's running too hot right now, and you're hearing that a lot from a lot of these CNBC folks and Wall Streeters, okay? Let me just make this very clear. That's almost never an issue, okay? It's almost never an issue that the economy is doing too hot. So don't think because the economy is doing well, the stock market has to do bad. The only reason it matters right now in the short term is because inflation is still relatively high, right? And so the fear is inflation is going to continue on and on and on, right, as the economy's hot. And once the economy slows substantially into a recession or whatever, that's when you get inflation down. So just don't get screwed up. Like, this is a freak kind of situation here. And I can tell you for the future, when the economy is usually going down, usually the stock market is going to follow it down, at least for a given moment, right? And if the economy is getting better, usually it's a good thing for the stock market. This is just a very freak time we're in right now.
And inflation's running hotter than people expected. So as long as those two are going together, I'm not overly worried about it. I think the bear case scenario is that inflation stays very high and the economy falls apart. And we're not getting that. Sort of the bull case scenario is that inflation comes down and the economy stays okay. We're not getting that either. And that's what I think people were looking for coming into the year. But obviously, employment and inflation are the two metrics that people are focused on. And so your bearishness or bullishness depends on what your outlook for both of those are. And if they're going together as they are now, that they're both hotter than people expected, I think we are kind of in this trading range.
Yeah, the best case scenario for us bulls, right, is that as the year ticks on, inflation numbers get better and better, right? Next thing you know, CPI is in the 4s and then the 3s and then hopefully the 2s at some point in time, right? Fed starts cutting rates, right? And simultaneously earnings hold up. That's the ideal situation for bulls, the ideal best situation. And then obviously it's off to the races if that were to play out. And that's not a scenario I think a lot of people are even considering right now, including a lot of bulls. We'll see what happens. Hope you guys enjoyed today's video. Thank you, everybody that subscribed to the channel. Appreciate y'all. We're approaching 24,000 subscribers. Also, thank you, everybody that supports the channel on Patreon and enjoys the content, supports us on there to see the stocks I'm buying and selling in that portfolio there. Check out the description area. Also, be the pinned comments, a no-brainer. Much love and have a great day.